This conference will now be recorded.
Okay, welcome. This is class number 3. Today's February 13th. Type in the room. Want to know how everyone's feeling this morning? How are you feeling? Are we ready? Are we grateful? Are we feeling healthy, happy, positive, focused? What are we? Love it. Feeling good. Eager to learn. Love that one. Excited. Brilliant, Owen. Amazing. Well, that's always nice, Ellie. Great. Love it, Sid. Donna's only good, but she lives a great life. Hence, she's only good today. Trevor's feeling good. Every day's a new day. That it is, my friend. With that being said, please, if you're looking at the first slide, this is just asking if you guys could please like, comment, and subscribe to our social handles. As you can see, we deliver this community with a lot of brilliant content. You're getting a strategy which took a long time to develop and also put together to teach you. All I ask and all we ask as MMS is if you could just please follow us, subscribe, like, and all the other good stuff. Thank you. And now, as we know, quick read, couple of minutes, confidentially notice, and the disclaimer. It's the same one that we've been putting up every day. This is just to make sure we protect the interests of the company. It's going to be up. I'll leave it up for another minute or two before we begin. So as we're going through this, and some of you who have your platforms up and who have been in the classes, who over here right now is finding they have a keen sense and active attention towards certain stocks? And name any stock that you are really honing in on. Just from the last few days, from what we've been discussing and what I've been teaching, is there any particular stocks that have really caught your interest, even in 2 days of learning? ACHR, OKLO, yep, SMCI, OKLO from Ellie, absolutely. Tim, all three, ACHR, OKLO, and SMCI. Interesting, isn't it? And are we all starting to see how the builds can be different, but how patterns are repetitive also, whether you're looking at it as a day trade, intraday trade, or a longer term trade? Are you noticing how those patterns through the day, weeks, months still repeat themselves? Who's noticing that? That's all it is. Remember, the methodology used to build, whether you're building for a quick move same day or you're building for something that you're going to move maybe weeks from now or months from now, building is building. There's only so many ways you can build. And if you have a lack of volume, then it's gonna dip and it's gonna flow and it's gonna use the volume as it the volume is going to be justifying how they're able to pick up shares. But if you've got a huge consistent flow of volume, then obviously it can consolidate in a tighter range. So in the end, in order for them to be able to build, whether that's at a higher, tighter consolidation, or whether they have to bring it back, pull it back, and buy shares lower, what in the end gives them the ability to do either or? What's the most important aspect of the build and how they can build? What do they need to see on a daily basis? What do they need to have in order to be able to build higher in a consolidation? Or if they don't have it and it's coming in patterns, they have to bring the stock, pull it back, and build on the way down. Volume, absolutely. Thank you. Interest, retail participation. Because at the end of the day, who are they acquiring their shares from? In the end, they're picking it all up from retail. So if you've got really high consistent volume, then it's extremely easy and quick to build your position a lot quicker. Now ask yourself, if they have all of the consistently high volume on a daily basis they require to build, and yet they have extended further and further the build, as I will show you quickly before we get into this, because I just want to quickly recap yesterday. Can you guys see my screen here? What stock is this? This is ACHR. Now, when we look at ACHR, this is going to be going from mid 2024. If you looked at mid 2024, as I was talking about yesterday, the volume was very low. What does it say when the volume, as you can see here, if you look right here, now you're averaging around about 45 million shares a day, let's say, and you're in an extremely tight consolidation, which means they have the volume they need on a daily basis in order to keep this in a very tight consolidation. Typically, when you've got all the volume that you need on a daily basis, you can acquire your position rather quick and make the move up. So what do you think it means to say when not only do they have the highest level of volume they require, they're using all of that volume as we see on a daily basis to simply build this massive position? What is that telling you that they're taking so long, even in this build phase? Which, let me tell you, if you go back to Palantir, that went on for many, many months, very, very similar to this. But what is it telling you that even with maximum volume, maximum buying, that they're still taking a long time to build? What do they see happening here? It's higher confidence and higher expectations are all aligning up, thinking this has a huge trajectory. But more importantly, when you build of this nature, do you think it has potential, or do you think it's going to be part of the framework of our economy and ecosystem, or what have you, moving forward? Going to be here to stay. That's right, because the reality is, like we spoke on yesterday, if many 10, 15 years ago, there's a lot of people who didn't have faith, or 20 years ago, not even that far, let's say 10, 15 years ago, in electric vehicles, in the ability of AI and how far that could go. And, all these advancements that have been made were questioned so many times. But while they were being questioned, do you all think there were some bright minds let's call them market makers, who strategized, did deep research, and said the potential is too high for us not to have an active position? Do you think that was a possibility? That there was a lot of these institutions, while all the retail and all these people in the media were questioning everything around them, there was a bunch of people who knew better and said, we have the network, and we have the communication lines to the people that matter. We've seen what needs to be seen. We understand the technology and the concept, and we understand the viability of this. And we are going to put a huge position down and put an investment within these companies to see that through. Who believes that is true? I love that. And obviously Donna responded straight away. She's been in this field and around these types of huge companies for many, many years. So she knows exactly what happens. And absolutely, Kevin, definitely. This is the truth. So if we looked at ACHR, one of my biggest giveaways, apart from the obvious of absolute buying, when I say absolute buying, I mean, I'm telling you, I've been watching this from here. And then really caught my attention is when it dropped back down and came to this 8. Around about this 8, the buying caught my attention. I even put it in the room because it was ridiculous. It was absolutely ridiculous. That buying alone If you all remember, what price target did I give that buying alone? Just the buying at 8. Who remembers the price target I gave that? Nope, was not 15. Calculated move. It went from 4 to 8. What's 4 to 8? 4 to 8. Let's step by step. What's 4 to 8? $4. Within the $4 move, I'm also paying attention to what type of volume it took to get from 4 to 8. So when I'm seeing that the volume remains consistently high and is building at 8, my next trajectory was 12. Did it go to 12? Did it meet my price target? And some of you were in this trade. Austin, Millen, I know you two were. David, I know you were early on in this trade. What happened at 12? What happened at 12 and up to 12? Who remembers? Who's been paying attention? I don't like the more buy. That's too easy. That's too easy. Come on, let's get better with our terms. Do we want to say more buy, or do we want to say the same type of massive buying all the way to 12 and at 12? There's been no stoppage of exceptional buying from 8 to 12. Do we have an agreement that the exceptional buying never stopped from 8 to 12? That was quick. Now, 4 to 8 released, but was not really a release. It was exceptional build. Then it went into this consolidation. In the consolidation, it was exceptional build, and then it released to the 12, exceptional build. Then it pulls back. What level is it holding, people? What level is it holding? If it goes from 8 to 12 on exceptional build and comes back and holds the same 8, which it released from, and does nothing but build for basically a month right now. It's been in this line for a month. What are we thinking is the next price target? If 4 to 8 calculated, 8 to 12 calculated, but then it comes back from 12 over 8 and now builds far more. What are we thinking? Love it, Trevor. Thank you. 16. Trevor, explain why 16. And Trevor's right, 16. No, Mike, just quick pattern. I'll talk about it. So basically why, because I don't want to do Q&A right now. Q&A is going to be at the end. It's not only a measured move, but double the build in the same relative sense means double the target. Does that make sense? If it was building that much to go up $4 and now it comes back and we're building minimum twice as much, our next move is 16. But when we say 16, what number do we pay attention to first? Now, if we know that all they've been doing is exceptional build from, I don't know exactly what happened from 4 to 6, but I was watching it from like 6 to 8. But long story short, ever since I've been watching this for now, December, January, 2.5 months, it's only been exceptional build. So although the calculated would be 16, but we say 15 being a psychological number, all of this is build. So what is the reality that the minimum that this should get to? 20. Brilliant. Why 20? What happens at 20? Psych. And liquidity. The liquidity will be at 20. Now, let's go further in our minds. If we said the liquidity is at 20, are we hoping or thinking they're going to be selling it all to retail at 20? What if they use all the liquidity to acquire more, keeping it even more? What does that say to you guys if that happens? What if it doesn't, if it goes to the price target after all this build and just keeps eating up even more shares? I love that answer. Who was that? Anthony. 20 is just another build level. Love it. So let's say they're all building between 4, 15, and 20. What does that mean to say that these big institutions who are holding huge positions really believe about this stock? Let's take this as far as we can go. Because the further we plan, the less surprises that come our way because we are now ready with options. Does that make sense? The further you plan out and add options for one way or the other, for those of you who have been in my day trading night reviews, I always say I want the two options, the one greatest percentage and the lowest percentage, but we need to know how they both look. So if you're planning further out, and if we start seeing that when it gets to 15 and it gets to 20, there's no change but exceptional build, nothing but more levels to command shares and acquire, then what is that telling you about what the institution really believes about this stock? One, this is absolutely going to be a possibility of this being a huge player in the framework of advancement and progress as we see it. But does that imply in any way they do not see this sitting as a 10, 20, $30 stock, but this is a stock that just has as much trajectory as it could have? See, we can't really put a number to it, can we? You can sit here and say, oh yeah, Doug, it's $100 stock. Is that a fair assessment of anything ever? Absolutely no. When you start living in the clouds, you fall down to earth and it fucking hurts. Do not live in the clouds. Clouds don't exist. So when you do this, don't sit to yourselves and write down, oh, this could get to 100. Hey, hope is beautiful, but you can't do what with hope? Have you ever taken hope, wrote that on a check, wrote hopeful money, and the bank has deposited that for you? Has anybody ever had that happen? If they have, I would love to go to your bank. Does anybody have hope deposits in their bank? You don't? Okay. But remember, if you ever find it, give Doug a bell because he will definitely going to show up with his hope check. Right. That was just a quick recap of that. Was that good? Did that guys make a few things clear from yesterday? I just wanted to recap a little bit for you. Perfect. All right. So now let's go into today's session. So this section of the option strategy, and remember, I'm breaking it apart completely. I'm not leaving any stone unturned so you guys have a complete understanding of what's going on. So this is assessing the price target ladder, creating the option strategy and position of our purchase contracts according to the price target possibilities based upon the variables listed below. We use this formula to buy our contracts at one or multiple strike prices and subsequent contract end dates. Price target ladder variables. Acquiring projections. Is this short term, mid term, or long term? Remember how we've discussed that even within a strategy, you have short, mid, and long term possibilities. And your short term is typically when it moves from one area of build to another area of build. Those of you who have played options will recognize if you get in at the right time, and we do for the most part, because we're basing everything off prints, You can get in, and in a few days or a week later, it already moved away from that build period area to the next build area. How many of you have been in that position and seen your premiums go up 2, 3 times and just looked at it and said, I literally just got into this and I'm up 200, 300%? How many of you have had that situation happen to you? Derek, I know for a fact. Donna, Trevor, brilliant. Tim, Kevin, Anthony, excellent, excellent. Now, how many of you quickly say, great profit, take it all off, forget about price targets, and forget about all new information? Come on, be honest. Be honest. Of course you do. You put $1,000 on, 3 days later it's $4,000. Of course you're going to take it off, right? And if you didn't take it off, then you are not learning to trade. Reality is, initially, we all want to take it off. Of course we do. But now, can you, if you're playing the short, mid, and long term, and you've got a staggered ladder, which I'm going to teach you next, you can create a strategy where you know that's going to happen. You know that's going to happen. You know it's going to move from the area of build at some point and leg up. That's a time that you absolutely, if you want to take some chips off the table, I agree with that. If you guys remember, type it in. I have a rule which I follow. What percentage, if I get to, do I usually take 50% off if I don't see enough to hold? 300%. That's exactly the number. And why is it 300%? Because of what I just told you. Sometimes when you get into that first leg up, you're up 300, 400%. You want to, what is the first rule of being a consistent trader? What are you meant to do first and foremost? Always plan for. Control risk. Now, let me ask you, is everything we see in all these options and is great buying, is it going to work out 100% of the time? No. Why is it not going to work out 100% of the time? Apart from the fact that nothing's ever 100%, you don't know what's going to happen. Every day things are changing. The market's changing. The economy's changing. Technology's changing. I mean, let's keep it real simple. If the CEO of ACHR got caught in child pornography or something ridiculous or something naughty, do you think that's going to affect? Right? How many times have you guys seen these companies that are doing so great, and the next thing you know, somebody in the C-suite level gets in trouble or does something wrong, or somebody says something? It happens all the time. So when you don't know and you've got 100% of your chips on the table, the one thing we can't forget, no matter how much we love everything we're seeing, is that there is doubt every day about the factors that we cannot control. So if your position is up to 300% and you stuck to my rule and said, Doug, guess what? I like that rule. No matter what happens, I'm taking 50% off anything above 300%. Do you think that's a bad game plan overall? No, it's not. You take all your investment back, and no matter what happens, how much is your return percentage? No matter what happens to the remaining 50%, how much do you end up returning to yourself no matter what happens? Let's see who's good at their math. 50%. There you go, Kevin. 50%. Is anybody mad here at getting 50% return on their money? And I don't need Donna answering. Everybody else. No, of course not. So that's acquiring projections. That's why short, mid, and long term is important. typical daily range of the stock within its typical volume versus breakout volume and range. Same as what I was showing you in ACHR, how the volume and the range was prior on the daily to the new levels of interest coming in. That makes a big difference to how much the range can go, is all based upon how much volume is coming in on a daily. Time of calendar year that our new position is starting to take shape. This is so important. Who remembers what I said would happen in January of this year? And I said that in December. Was it true or not? Did it happen? I love that. Definitely, it did. Why can't someone type something like this? This one's for Priyash. This one's for Priyash. As I've told you all, when you come to any of my classes from now until eternity, I love humor. I love active learning. I want to get you all involved so you're having fun. And believe this or not, for those of you who understand psychology and enjoy psychology, like Ellie, the happier you are when you're learning with a smile. The part of your brain that wants to accept will now come to life, and you will learn more when you are calm and when you're in a happy state. So that's why I always have a few jokes. And by the way, Ellie is a psychologist, psychotherapist, everything. Right. Sweet spot. I will go into the sweet spot next. My sweet spot, which is going to be its own page, I will go into on its own slide. Trade management. Arrange early and allow freedom for adaptation. Formula. What percentage of investment is placed among contracts percentage? Okay, so these are all going to be slides. So, assessing the price target ladder, acquiring projection short, mid, and long term. The strike ladder. If we see the buying for extended possibilities beyond the initial target, we take more calls or puts further up or down the strikes prices given, i.e. purchase calls for strikes 12, 15, and 20 for the same expiration. So if we were looking right now at ACHR, we're just going to take ACH. Actually, let's take OKLO. And the only reason I say OKLO, and I'm going to pull it up, and we're going to use this for talking about this particular slide. Millen, we can't put up two slides together, can we?
No, we can't.
Okay, all right. So those of you who have your platforms, try to pull up OKLO on the daily. If you're able to pull it up and you have a platform like you should have, just put chat, type in the chat, have it up. Perfect. Love it. Brilliant. 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 Love it. Okay. Unfortunately, I know there's some of you that don't. Okay. Thank you so much, Trevor. I was going to say, if somebody could just take a picture and just put it in Discord for our students who haven't quite got their setup ready yet. I'll give you a couple of seconds just to get in there because I do need you to watch and look over that chart. So let's go through this first, and then we're going to talk about it straight onto the OKLO daily. So we talked about the strike ladder, the date ladder. If we have witnessed more than one of our three forms of acquiring, which means a short, mid-term, or long-term, we can take closer and further out dates, i.e. short-term buy, so we take 4 months out. And if we see mid-term prints and possibilities, we add 6 to 8 months out contracts and create a staggered approach. This is what we call a ladder or a staggered ladder. Strike and date staggered ladder. Many times, in order to capitalize on the bonus exception, typically far low percentage possibilities. So we can only purchase maybe 10% of our total investment, but we can purchase cheaper contracts and attain a healthy base. Exceptional buying. This is not only shows a huge and clear intention, but many times they buy up to the new perceived value. Exception buying from 11 to 14 and continuation of strategy above 14 when exception is completed. So this exceptional buying is basically what we're seeing currently in ACHR. Are we seeing exceptional buying in OKLO? Are we seeing exceptional buying? Are we seeing exceptional buying in OKLO? When would you have seen, as we did? Perfect answer, Trevor. When is exceptional buying typically occurring? What stage of the move? Begins with F. I want the right terms. Foundational. Who sets the foundation of a stock? Market makers, the institutions. And Trevor's right, they were in the beginning. And you got your charts up. You all remember because I talked about this in October when I saw the buying under what level? And I said it was massive, exceptional. Where was it? Under what number? Look at your charts. It's clear in October. Not quite 15, Trevor. 10. Between 8 and 10 was exceptional buying. So let's just say, Briesh, that an institution from 8 to 10 had built a position of, let's make it easier and say 10 million shares. And these are the foundational investors of OKLO who have seen a huge potential for their future. How much are they up right now if they own 10 million shares at $10? Let's just keep it at $10 to make life easy. How much money are they up right now? $400 million. And yes, Shams, that too. But yes, 400 million. Do you see the difference between who sets a foundation and who can't? Who sets a foundation and who can't? They're the only ones that can do exceptional buying. Type it in the chat. Large institutions are the only ones that can strategize exceptional buying. Large institutions are the only ones that can strategize exceptional buying. So when you see exceptional buying and it's continuing for days and weeks, what should you be thinking when you start seeing that? So if you're watching a new story, a new stock, and you're seeing exceptional buying happening for days, weeks, months, what should you be thinking? You should start planning, because guess who's showing themselves and showing themselves with might and rigor? You're seeing them now. Here's the next question, because right now we're talking about the strike ladder. So we've seen, let's just say it's February right now. OKLO. We're going to be talking as if it's OKLO starting in October. Okay, so let's just go back to, let's make life easier. Today, we are in October talking about OKLO. So we've seen now for 2 weeks exceptional building. The longer the exceptional building, do you think I want to take strikes just 4 months out? Why? What's the problem with me going just 4 months out? Yep. It's not enough time, as Brioche said. You got to go mid-term to long-term. Because the reality is, the longer it buys, the longer it could also take to get to the price target. The longer it buys, we still don't know how long it's going to buy, do we? So let me ask you another question. Do you take your position or all of your position within, let's say it's been consolidating and buying exceptionally for now 2 weeks? Is that your first position based upon that? Would that be short term, mid term, or long term? Your first position. So let's say you're planning that you'll take up to 10 calls in this certain stock. And you're like, okay, this is a long, extended foundational building period with exceptional buying. It's now gone on for 2 weeks. I'm not sure if this is going to go on for another week, 2 weeks, because one thing we can't tell in exceptional buying, as we can't in ACHR, is what's going to trigger it, when they're going to move past it, when they're ready to release and go to the next level, whether they're waiting for some form of news, whether they're just waiting to acquire more and more shares. You start further out, you mitigate your risk straight away. And where would you go? So if you don't know how long this build's going to take, but you love the build so much, what's the one thing you want to make sure you don't do? You don't want to go too short in your contracts. Because if they're building this much, that what does that do every day and week to the possibilities of how far this could potentially go? It's extended. So now, could you imagine you took that position in October in OKLO and you said, okay, I'm not going to listen to Doug and I'm going to take the 25 strike 2 months out and I'm going to get out in January. Oh, sorry, you October, November, December. Yeah, you said you're going to take the December strike and you're going to take the 25 and you're going to make a lot of money. How would you be looking right now? Or how would have that worked out for you? So you're in October. We're seeing this for weeks. We're seeing it's exceptional buying. We're seeing they're building a monstrous position. We understand what OKLO is and how they could impact the future. And you know that the strategy that's been taught to you is, whatever the case, never buy less than 4 months. But you get antsy. You say, oh, I want to buy a new TV for Christmas. I got to buy my girlfriend something nice in case she leaves me come January. Mum's been complaining I'm not a good boy. Let me buy her something. And then what really happens to you in December? Because you didn't listen, you didn't plan on what you see. You got greedy. And your strike was 25. And then you got to December and nothing. You lost a little bit of money that you had invested. And then your friend Shams texted you and said, why didn't you just take 4 to 6 months out like you were taught? So Shams being so smart and PJ wanting to buy himself a new teddy bear for Christmas, who now lost his investment, Shams over here has February 17th. He's still in his active position. And his strike price was 30. How's Shams looking today? I would assume so. Who do you think bought PJ a teddy bear for Christmas? Who bought PJ his teddy bear for Christmas? Shams did. So, jokes aside, never ever allow any form of emotional opinion to give advice to your trade. Type that out. Never allow emotional opinion to give advice to your trade. Type it out. How many of you are guided by your emotional opinions far too much in your trades? If you said I used to be, that means you probably still are. Love that, Austin. And Austin, you got emotional looking at OKLO last week, and I remember you messaging me. What was that emotion centered around? And it's not easy, don't get it wrong. Money. Because were you up a lot of money when it was at 59? Were you up a lot of money at 59? I know you and Millen have very similar entries. So if you were up a lot of money, let me ask you a question with your FCK, yeah, mate. What happened at 59, Austin? And at 58, Austin? And at 57, Austin? How many times was there buying at 59, Millen, Austin? I know exactly how many times it was. I can still remember it. 3 times execution of massive prints. Let's go ahead and make you feel even worse, Austin. Let's say there was 1,000,000 shares purchased at 59. How much did that person put money? How much money did that person put there? $59 million investment at the top of this move. And Austin was getting greedy about his position that he's been since the 20s. Yet there's someone up there who put $60 million. Are we truly following at that point when we have that moment? What should you do as my golden rule when you fall off your horse a bit too much? What should you do? Well, you're in the trade. Don't forget, Austin is in the trade. If you're in a trade and you lose the discipline, what do? I don't care. You have to do this. Get out. And what I would say, not 100%, not 100%, you get out 80 to 90%. Because what must you still continue to always do no matter what? And we need to have some skin in to do it. Learn. Because you're not going to learn how to get past that emotional barrier if you simply get out. Is that true? If you completely get out here and turn it off and next stop, did you get through that emotional barrier? You didn't. The key to progress is to get through that next puzzle. See, if you try to tiptoe around a problem, it's only going to be waiting for you again. Problems don't come your way because they like to fuck up your progress. Problems come your way because they want to know if you deserve to be progressed. Does that make sense? Problems don't come in your way to fuck up your progress. Problems should be seen as puzzles that are testing whether you should stay progressed. Does that make sense? Brilliant. So when you're looking at OKLO and you went out and saw what happened in October And now we plan, right, I'm going to do short term because 4 months out gives me plenty of time for a leg up at worst case and potentially more. And when I say potentially more, because if that build, exceptional foundational build is complete, and now they're going to do building and go, build and go, build and go, and we have really good, consistent volume patterns, we can get out of our short terms very, very, very profitable and a great return. And then we can allow our 6, 8, or 1 year contracts to then take care of every other part of the move if it's to happen. And if it doesn't happen and we get capped at a price target and it doesn't see any further current reason to be valued higher, are your midterm and long term calls going to be profitable anyway? They are. They're all calls in the same time at the end. Now, that's how you want to do it on the target ladder. Now, what I do, if you looked at ACHR, let's just stick to OKLO. OKLO, I watched it. Yes, it had all this build. But then even when it legged up and went towards this 20 and 28, between 18 and 28, what did it do? What did it do between 18 and 28? Now look at this. October 22nd, all the way until January 3rd. You're talking 7 weeks. What did this do for 7 weeks? It wasn't exceptional, but what did it do for 7 weeks? Build. And it built massive. So what does that say to you about the next leg up? There's a whole new set of investors. And why is that? Well, imagine after the first news, they got report that they were given provisional yes for their pilot program. They got their United Airlines agreement. They got Airtold to come in and back them so they can use their technology. So with that information, which came out in October, do you think that opened up investment criteria to new institutions and firms and what have you? Do you think that new information said to other people, now it's time for us to come in? So now you've got all these new institutional investors, but they're building their position from 18 to 28. Have they made their money yet? Have they took it to a certain price target yet? Not yet. And they've been building for 6 weeks. But if it's not exceptional build and it's just build even over 7 weeks, do you think it'll be a slower leg up, or you could get a lot larger leg up because they're buying, catching, and moving? It will be a better leg up. It can get even further down the line. It can move even further towards targets because once all the institutions are really tightened up and in at the bottom, they're going to start playing their games to move this as far away as possible. But what happens when we get to 30, 35, 40, 50, 55, 60? Well, we're not at 60 yet, but 55, and we don't see any lack of What is that saying to you all? Would this be the situation where you wanted short, midterm, and long term contracts, or as I call it, playing the ladder? Is this where you want to have different strikes? Is this where you want to say to yourself, after, let's say, you saw everything in October between 8 and 10, you then witnessed every day the buying that occurred between $10, $18 and $28. When you see something of that nature, not only are you going to play the ladder, but are you not going to say, this deserves a percentage of my investment to buy the most out the money calls I can? Because let's just say you looked at and this was back in, let's say, December, and you're like, oh my word, the buying don't stop. This is just continuing. This, my price target for this is already 35 or 40. And if the buying don't stop, this could easily get to 40, 50, 60. Now imagine in December, if you bought the April, and I'm just making this up, April or May, so 4 months or 5 months out, you bought the sweet spot. So in the sweet spot, which I'll go over soon, never pay more than $2.50 a contract. But let's say I'm just going to make this up. Let's say that 35 strike for April 17th, and this was when you're looking at it in December. So the price for the April 17th 35 strike in OKLO was $2.50. But the 50 was $1. Do you think in this particular situation that you want to stagger your strikes in the ladder? So when it's stagger means staggering your strikes. I'm sorry, staggering is staggering the strike dates, so all your contract dates, April, June, July. Ladder is within that 1 month. Are you taking different strike points? Do you guys understand that? Why I call it a staggered ladder. So stagger means taking, let's just say, for instance, I said, I want to buy, or even a dollar amount, but let's just say out of it, make this easier, I'm going to buy 10 calls. So if I wanted to just literally stagger my calls, I'd say, okay, I'll put 4 calls or 2 calls 4 months out, 4 calls 6 months out, 4 calls 8 months out, and I'll make sure I don't pay more than $2.50 maximum. That's a straight stagger. Understood? So if I was looking at OKLO come the end of October, I love what I see. I've already created a target for this to go to at least 20. Then I say to myself, there's so much buying coming into this. And then I take my first position 6 months out in October. Then come December, I'm like, this buying hasn't stopped. And now we're building these massive positions of between 18 and 28. Now I'm going to stagger it out and I'm going to take some calls that are another 6 months out, another 8 months out. But I'm going to stick to every one of those being at 250-ish. That's called a straight stagger. When you stagger ladder, that means that you go and say, right, 8 months out, I'm going to buy the 35 strike for 250, but I'm going to take 30 or 20% or 10% of my investment that I was going to place in this position, in this entire position for OKLO, and I'm going to buy the most out the money possible. So you're like, okay, they got 55 for 50 cents. Does that make sense in this stock to do that? You guys are slow today. What's going on? Is it the end of the week? Too much information? Yes, of course. Now, right now, if you'd been doing that and you had $50 strikes for June that you only paid 50 cents for, and it's already trading well above 50, how do you think your return on investment looks when you pay 50 cents for a share, but your return is dollar for dollar? Because remember, once you pass the strike, it's dollar for dollar. So if you had 10 calls at 50 and it's at 52 or 55, remember, 10 contracts are the equivalent to 1,000 shares. So if you paid $500 for 1,000 shares to control over 50, how much are you getting back every dollar it goes up? $1,000. So if it goes from 50 to 60, your profit is $9,500. How does that sound on a $500 investment? That's where you can take advantage of that massive run and you end up getting a return on your investment on the out of money calls that can be so significant. So that's why staggering the ladder is important. Now, Let's take this quickly for same situation now for ACHR. Who's going to stagger the ladder in ACHR? Or who's going to say, Doug, I don't think I want to stagger the ladder as much as I want to go far out and just have a ladder 2 years from now or 1 year from now? What are people thinking when they see ACHR? Let me ask someone. Okay, January 2026 is what Derek just said. And Kevin, brilliant, which is January 2026. So a year out from now. Okay, let's just, I can look it up right now. We are here. So hold on 1 second. While we are on this, why don't we just pull it up? Give me 1 second. I'm going to show you right off this. Hold on 1 second. This is not investment advice, Derek. We're teaching, so I don't care what the price is. I just want to show you guys possibilities. That's all. But what I need to do is hide my account number first. Okay, I can't. All right. Here we are. Okay, give me 1 second. Sorry about that. To make sure all of my account information is not showing, because I do trust you all, but remember, this is going to be going out and there's going to be a lot of random people watching this on YouTube and what have you. So I just got to make sure I protect myself. I'm sure you guys understand that. Okay, so now let me share this quickly. Okay, can you guys see that? Is that clear enough? I'll explain it to you. I just want to make sure you guys are able to see that. Yeah, perfect. Okay, right. So this is TradeStation's option station setup. If you look here on the left, these are all your dates. So it's always the third week of every month. That's your monthlies. We don't do the weeklies. Stick to the monthlies. So look, February 21 monthly, March 21, 2025 monthly. Now we're going to go to and this is what's available. You can only buy contracts where they have availability. So now let's go to January 2026. On the left side, this is all the calls. Okay? Understood? Left side is all the calls. In the middle is your strike price, $250, $350, all the way to $20. On the right, these are your puts. This is if you think this company is not going to make it and it's going to fall back. So if we look at January 2026 and you look at this side, this is called open interest. Open interest is the amount of contracts that have already been purchased at that strike price. So at $2.50 for January 2026, there has been 2,455 contracts established. If you go down all the way here to 28,000. Above it, 18,000. Are we seeing the size of the open interest at every level here in January 2026 ACHR? Do we see that? Now look at the other side and the amount of puts we have. Do you see how that's far, 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 far less? Now, a lot of times, just to let you know, large institutions, they buy massive positions and they hedge those positions with options. Did you know that? Now, let's use a bit of this thing we spoke about yesterday. Bit of common sense. What price is ACHR? $8, $9, $10? Let's be realistic. We're better off just calling it $8, $9, right? It's basically nowhere right now. Would you all agree that it's not at any price point that makes anybody any type of real money when you're an institution? Because they're building, right? Does it make sense for them to buy a bunch of calls to hedge a short position at the current price? I'll repeat that one more time. Kevin, that's what I'm saying. Please, everyone, use a bit of common sense. Does it make sense to short an $8 stock when everybody else around you is buying? One, and two, how far of profit do you have shorting an $8 stock? How much possible profit do you have? Come on. Does anybody ever cover their short at zero? Where do shorts typically get covered? Under what number if it falls below? What's the number? Nope, it's not 1. 5. Thank you, Alex. Thank you, Anthony. 5. 5. 5 is your number. So, do you think anybody's going to hedge a short position from 8 to 5 and buy thousands of contracts just in case? Or does it make more sense to forget that stupid short for $3 and believe in the company like everybody else and buy a bunch of contracts a year or two out? Exactly. Now, if ACHR was at 80, was building between 90 and $100, and this was not 20, this was 200, 170, 150, so all your strike prices add a zero. Now, does that make sense? Someone saying, you're crazy. ACHR is already at $90 to $100. It absolutely does not meet the valuation. I'm going to put a $10 million short position, but I'm going to buy some calls long just in case I'm the idiot and not the market. Does that make sense? Makes a lot of sense because at the end of the day, why do you short? Use a bit of common sense. Why are they shorting? We know there's room down, but what are they looking to do when they short? What are they looking to do when they go long? Why'd you go long? Why'd you go short? Make money. Make money. Does it make sense? Is that a great investment to go short at $8? Is that a great investment? Now let me ask you another question. You're going short at bloody $8 and now you're buying all these calls as well. Now, obviously, if you bought the calls and it's at 50s or 60s, you don't give a shit about your short position because you made your money in the long. But was there any point or was there any high percentage short at $8? Is that a high percentage risk to return? No. And is ACHR at any stage that you should be doubting it yet? Think about that. Think about that really deeply. Is it at a stage that you should even doubt it? Or should it be nothing but optimism for what they could provide for future? Should be optimism. So, going back to this, as Derek was saying, if you looked at the 20, so let's say you wanted to get your furthest, and I don't, yep, that's all they have. So they only have January 2026, $20 available. Now, this is the ask and the bid. So the most you're going to pay right now is $1.61, and the bid is $1.54. So if you bought one contract, you're going to pay $161. Now, let's say this. What's our target? What's our first target and second targets? $15 and $20. If you were right now and you purchased the 15, let's say, for $2.28, from 15 to 20, let's just say, make life easier. We're going to use, for some reason, I just like using 10 contracts because it's 1,000 shares. So you bought 10 contracts right now. How much are you spending to buy 10 contracts at top price? Let's just say for strike 15, January 2026. How much is it going to cost you if it's $2.28 for 10 contracts? Thank you, Tim. Thank you, Kevin. Priyesh, Milan. Absolutely right. Milan, I don't know where your math is gone, mate. 22.80. You can't round off. If you want to give money away, I'll send you my Zelle right now. You can send me $20 every morning. How's that? Right, so you're paying $2,280. How much are you going to make if in a month from now ACHR is sitting at $20? So you've bought this position today. You've spent $2,280. A month from now, it's at $20. How much are you up in profit? We're not talking about net profit. Around about. If it's $1 for $1, 15 to 20, so about 5K. Exactly, Alex. You're about 5,000 up. Now you minus your investment. Thank you, Austin. Thank you, Tim. 2720. So as Anthony rightly pointed out, in a month you'd be up 200%. How's that looking? Now let's say it goes up to 25 in 2 months. Now you're up how much? So let's just say 10,000. I know Alex is going to put 10K in there. So we put 10,000 minus 2,280. What does that give us? And then give me the percentage return. I'm just picturing so many of you pulling out your little calculators and trying to quickly calculate this. Kevin, not 200%. If your investment was 2280 and your net profit is 7720, you're about 350%, correct? 340. There you go. What did we say above 300% should be a strong option for you? Typically. Listen to the word. Typically. Now, what if take 50% off, and I would never, ever, ever question that because that is a very disciplined, smart strategy. Always use a disciplined start strategy. The only variables I'd consider different is what if it was nothing but buying all the way 15, 20, 25? Nothing but buying. Huge consistent volume. Conversations of new contracts coming out. One already established 3 weeks from now. And how much time do you still have left? So how much more time decay do you have? You still got 11 months. So yes, you can manage. I don't disagree. But does that also put you in a position to have your own exception? These are the options. I will tell you once again, if you said Doug, I'm sticking to the ground rules. I like your ground rules. I don't care if I have 11 months. I don't care if it's non-stop buying. I will continue following the plan, but I want to be a disciplined trader. I'm taking 50% off knowing there's more to come. I am not mad at that at all. That is absolute discipline. And over time, you will come out on top consistently. But you have the exception possibility of holding it all. You have the possibility of selling half. So let's say you sold half and it pulls back. It has that pullback moment. It goes from 25 all the way down to 20 or 19. But the buying never stops. Just the volume required it to pull back. What can you do? Oh, there you are, Trevor. You can always add back on a pullback. Perfect answer, Trevor. That's exactly what I was looking for. Does that make sense to everyone? Perfect. Millen, my camera just went off.
Doug, you're just gonna have to try sharing again. There you go.
There you go. Perfect. Okay. As you can tell, managing time is not my thing. When I teach, I will just keep going until I get my message across. Is that okay with you all? If you think that's all right, just say that's all right with me. Or as Sam says, let's go. That's all right, all good. Yeah, Prish had to use a bit of London terms there. You get me? Good here, beautiful. Right, let's move along. So, typical daily range of the stock within daily volume versus breakout volume and range. So, TDR is just me breaking it down, typical daily range. This is key as we know the aggregate impact of volume for the range of stock will move within. So when elevated levels arise, we can compute the trajectory based on those incremental changes. That's basically and if you look at BVR, that would be breakout volume and range. We spoke about that. So you've got your typical daily volume and range before the new interest levels, as we saw in October in ACHR, October in OKLO. Then you get to the breakout volume and range. Now the range is extended because there's more volume and interest. Chart increments, our secret use of the integers to understand the targets. This starts from the daily, but really when we're looking at long-term, mid-term, short-term, or swing trades, basically, I want you guys to follow, and you have this on your charts. Look at those calculated moves. That's how you're going to be doing it. Calculated moves is the best way to develop how the price target is going to go, as we have talked about the $4, the $8, the $12. And then that's where it goes to the calculated movement targets. When we observe the strategies used daily to acquire, we can see through the increments used or integers on the chart how much buying or selling is required to attain a certain price target, which we can then compound with elevated levels of acquiring and volume to plan future price targets. Plug BVR into the formula so you can create the relevant price targets. Do we understand that? We just spoke about all of this. This is how you create the price targets, understanding how the volume works before the interest, after the interest, and the relative range with that volume. Are we clear on this part? We spoke about this in depth. I actually started talking before I even got to the slides. So here's just a breakdown of an example. XYZ, as we can see on the left, typical, elevated, further elevation. And this is, have we seen on, do you figure the move? Kevin, let me get through all this because of the slides first, okay? All right, so typical. Now, let's say in your typical stock of XYZ before anything and how it just typically trades like we do before OKLO, IONQ, all these DJTs, all HIMs, all these stocks got all these new levels of interest. Let's say XYZ was typically moving $1 on a range. volume was 10 million a day average. It's increments on the day trade. So this doesn't apply to those who are now swing trading, but on day trade, let's say that our chart would typically say this moves 20 cents at a pop, increments. So small enough for a day trade. Swing calculations for price target is same day. That does not have enough movement, trajectory, or interest for you to even start formulating long-term options based off prints. Calculated the move, phase one, money time off build, $1.50, build phase for the next move, money time off build, move 150. So it's a very simple, basic, you can trade it, day trade it, but there's not any possibilities for swing trading. Now, all this new interest comes in. And now the volume has gone from 10 million average to 25 million. The range is now $2. The increments on the chart are saying 50 cents. So it moves from, let's say, $10 to 10.50 to 11 to 11.50. Now it has more juice that's worth to squeeze, so it's going to move more. So you can see the print sides, consistent acquiring at levels. The more volume, now we know there's market makers present. They got more work to do. The swing calculations for the price target. Each set of print spurts at controlling levels acts as an extra increment. So for instance, let's say on this new elevated volume, it comes in, and prior to the elevated, so in the typical range, it was, let's say, 6 to 8, and it stayed there for years. Now all this interest comes in, news comes out, a contract is signed for XYZ. Now all the market makers and institutions are showing their interest. They come in and start trading it, and they get to a level. So let's say typically, if buying or controlling print or a market maker showed his face at 8 and he printed there, it would move to, where would it move to typically? If a market maker decided to jump in that stock when it's typical range and he bought nice amount at 8, how far can it go? Typically. If it's got, no, the range is $1. The increments are 20 cents. So it's about 9. I'm talking about controlling print, so 9. So if it's elevated and now it goes to 10, let's say, and they buy 10 times at 10, they keep on hitting 10 and buying everything they have. Is that moving to 12? If they're bought at $10 on the elevated volume and they keep buying at 10, maybe 10 times, so 10 spurts at 10, each spurt is an increment. If you're buying that much at 10 on this new elevated interest, the stock can move in a range of $2. What's typically, without even looking at a chart, their most likely mental psychological price target at the minimum. $15. I love that. 15. And what is the second price target? If they bought 10 times at $10, knowing it can move $1. 20. Do you guys see how the basic math can just work that way? The simpler we make it and keep it, the easier it is to manage. Keep your trading as simple as you can. Now, the further elevation is the next volume pattern. Do you guys remember how OKLO had foundational volume and exceptional build, then 18 to 28, new levels of interest, but elevated levels of volume? Do you guys remember that on the chart? When you typically see that, you'll see it will even extend the time frame of build because they're not doing what? Why can that take longer? What are they no longer doing, which takes less time typically? Exceptional build is going to take a lot less time because they're eating up everything themselves. When they're building, it can take longer because it's not exceptional. There you go, Owen. Thank you. But they're building still, and they're building for a long period. If now the volume is at 35 million average, the range is at 250, and the increments are 50 cents. And what I mean by 50 cents, I can't write $1 because we want to keep ourselves disciplined. But let's say you can easily move a dollar with nothing and it builds and builds and builds. That means that we are now furthering our price targets because now we're seeing all this new level of elevated interest. Does this make sense? Good. Tim, Owen, Millen. Remember, note down your questions. I will still do questions at the end. Okay, moving on. Time calendar of the year of new positions I take shape. So time calendar year is critical when assessing how market makers typically have been seen to manage their positions and need to take into account the following. End of year, typically taking profits and possible assessing whether to wait for new positions in the year. So as we see a lot of times, they're closing the books for the year. They got to pay their taxes. So you see a lot of these large institutions and companies will take profits at the end of the year. Some of them hold it over through to the next year because they want to make sure that they, one, pay their taxes for the year, and two, most of these hedge funds are responsible for investor money. So they need to close out the books for the year. They need to show what their returns for the books were for the year. Do you understand that? December, January, these months see large sell-offs, as I said to you was going to happen in January. Why do you think? These months see large sell-offs, so we need to account for a high possibility in options. We could find a far better entry on a sell-off or simply wait for clarification on market sentiment. So one of the beautiful things about a big sell-off, why do you think they come in the new year and start selling down? I've explained this before, but why do you think, what's the most common sense method for, let's say right now, okay? Absolutely. You get a better price. Now think about it a little bit deeper. You ready for this? Kevin comes to Doug and says, Doug, I'm giving you $100 million. And I see that you usually return about 12 to 15% on your money. Absolutely. Thank you, Alex. Makes their returns look better because if I bought, and I'm going to make this up, obviously, if I bought Meta at $100 and he gave me 100 million, so I have 1 million shares. Are we on track? Follow me. If you're not following me, just say stop. Kevin comes to Doug and says, Doug, I heard that your fund usually returns a good 20%, 15 to 20%. I like the idea of that. I'm going to give you $100 million. So I say, okay, I've just got this new fresh money from Kevin. I make 20%, but I've got to show him that overall, the position can get anywhere from 15 to 20% return. Meta's looking beautiful. If I bought Meta and January opens up and Meta's sitting at $100, I buy it for 100 million, take his position. By the end of the year, Meta is at $108. What is my return for him? And that's not taking out the commissions to me. 8%. Now, if I went in first and shorted Meta with a bunch of other institutions and brought it down to $85, and then it ended the year at 108, would I have met the requirements that he was hoping for? Exactly. So does that not make sense that the beginning of the year, when you have to now start planning for how to get the returns back to the investors so they keep their money in, do you buy it at the high or do you short it first before taking his position at the low? What would you do? Exactly. You're going to go short, British, even better. British said you go short and you build at the same time. Absolutely. Love that answer. Short and build. Now, going on to what British just said, can a market maker short and build a long position at the same time? Of course they can. So do you think they're going to take advantage of their resources and privilege in the market? Absolutely. So then earnings. Buying right before quarterly earnings can be highly risky as the outcome of the stock price can never be truly gauged. So be aware of these dates. I've done this to test it, and I think I was like 18%. I was successful. Does anybody like those percentages? 18%. I think it was like 18, maybe even less. Stay away. So let me ask you something. If you really liked ACHR and their earnings were Friday, would you take a position today? Ask yourself that. ACHR's earnings are this Friday, so tomorrow. Let's just say they are. Would you take a position today, even after what you've seen? Ask yourself that question. Why, Kevin? Why, Ellie? Trevor, I don't need commentary. All I'm asking is yes, no, and why. The risk to reward isn't there. Disciplined trading based off percentages. Thank you, Kevin. That's the answer. Ellie, it's not the no time because you can buy as much time as you want. Go buy a year out. You saw the January 2026. You got plenty of time. But I love Kevin's answer. The risk to reward. Now, the reality is the risk to reward technically should be in your favor because you could say also to me, Kevin, is, well, then what about all the millions and millions and billions of dollars that all the institutions are placing? True. But do you have the ability to hold that long while it rides a wave and it drops down? Do you have the ability to buy more shares on a pullback like they do just so they can build a bigger position? Remember, their strategy is still different to ours because we don't have what they have. As followers, we're still retail followers. So would you be mad paying a bit more if their earnings were so great on Friday and it went to $11 or $12? Would you be mad paying more knowing that you got the validation from earnings? Or would you end up probably saying, I might pay more and take more calls? Who thinks there's a possibility that could happen? Absolutely. So that's the way you would play that. Now, the sweet spot. After hundreds of positions and deep analysis post-trade to determine which factors within my trade were executed successfully and usable throughout my formula, you also understand which variables can be strengthened. This can often be due to simple reasons, such as a lack of volume in weaker market conditions, which in turn require longer time frames for positions to meet their established price targets based on our assessment of prints. Sweet spot for contracts. Milan, could you at least share this with the options group, please? Because I know the video is going to be coming out sometime next week or the week after, but at least they have this part. So at least share this.
This slide, no problem.
Yeah, share this slide with them, please. So your sweet spot for contracts: never pay more than $250 a contract max, regardless of strike price. Now remember, you can do whatever you wish to do. This is simply the strategy that I employ. You don't have to do any of this. If you want to pay $7 a contract, that's completely up to you. But this is only from all of the hundreds of positions I've taken, all the data that I've put together, that this is where I've been highly successful, is to never pay more than $250 a contract. Now, you can go and do the staggered ladder and pay 10, 20, 30 cents all day long. But do you think that should be the bulk of your position, is taking far out the money? Do you think it should be smart to put most of your investment in far out the money calls or puts? No. The strike's there for a reason because we have a price target for the buying we see established. So what we want to do is be as close to that as we can, but not paying more than 250. Strategy timeframes. Short term, 4 months. Midterm, 4 to 6 months out. At a minimum, stagger through months of buying is exponential along with volume. Long term, position 6 months and more. Like I said to you in ACHR, 2026 is where I am. 2027 is where I am. In this approach, I stagger the ladder on their strike price, and on my further dates, add strikes at a cost of $1. That's the range could be a lot more. So basically, long term is the staggered ladder. Trade management. Arrange early and allow for adaptation. Initial positions are based on the prints and acquiring strategy you've identified. However, these can become one-dimensional if you stick too rigidly to the initial strategy. To avoid this, keep the following in mind. Further prints. Monitor for signs of acquiring that may raise the price target, unexpected selling. So not only is it that we're seeing new fresh buying as it moves up, be aware that if the volume starts dipping off and a lot of selling comes in, that could also mean that it's met its current valuation. It is now capped. That is also a time that you've got to pay attention to. That's why you must be watching the position that you're in as much as you can so that you can see what the money flow is telling you. And at that stage, you might need to start getting out most of your contracts. When they get out, you get out. Is that understood? Type that in. When MM start getting out, I start managing. When MM start getting out, I start managing. We are followers. Or even better, when MMs are managing, so am I. Volume. Volume patterns are crucial to the duration of your strategy as they reflect daily interest. If volume suddenly drops or weakens, it could affect time decay and extend the time needed to reach a target, possibly requiring earlier management. Adding to your position if additional interest emerges, as we saw with OKLO, as we've seen throughout with ACHR. If additional interest emerges through both prints and volume, this signals a good opportunity to increase your position depending on the strategy you're following and developments after your initial entry. So if ACHR starts moving and the volume now goes even to a higher volume pattern and it starts buying all the way up to 15 to 20, do you think some of you are going to start taking calls even further out? There we are. Absolutely, you are. Formula. What percentage of investment is placed among your contracts purchased? If we are purchasing contracts based upon a specific monetary number invested, then it's certainly advantageous to maximize the possible returns by carefully assessing how to distribute the money towards contracts at different dates and strike prices. Here is how I typically break down my placements in percentage. Short term. Typically, this is a very high percentage short term price target, so I place all appropriate funds into the max contract strike price in order to maximize the gain after strike. So, as we see in short term, when it's got that initial array of massive buying, that typically has the first initial big move before we get to the next catalyst if there's to be one. That's why I like to go in about 50% in my short term when I see that happening. Midterm, typically I stagger between two expiration dates with the further date buying contracts at lower cost. So if I've got midterm and I'm like, right, I'm going to go 6 and 8 months, what I'll do is instead of paying 250, the reason I'm going midterm is I see this as high more possibilities. I will go a bit more out of the money so that way I can get a better return if it goes that far and further. So, and the first date at the max sweet spot price and place 70% on the first date and 30% on the second date if you are doing that midterm. So 70% covers you on this 250 and then 30% you buy well out the money in case it runs far and those can take care of those. Long term, typically I have staggered ladder where I could have 4 to 6 different positions, but this is also where I will place a far larger investment. If you find yourself in a stock liking it so much that you want to go short, mid, and long, is that the one that you want to just tiptoe in, or is that the one that you really want to go maxing? That you truly believe this has got everything I need to see. Everything, every part of it is what we want. You go as heavy as your risk tolerance allows for. So type in the chat, as far as my risk tolerance allows for. As far as my risk tolerance allows for. Everything that you've typed in this chat are absolutely your words of affirmation of how to become a good trader. Make sure you're noting these down. These are all helpful. This will all trigger the right mindsets for you as you're trading. And with that being said, I believe this is our end of our first week of options. Brilliant, brilliant, brilliant. You've all been fantastic as well. Now, I will answer 2 questions quickly. So if anyone has a question, please ask me. Kevin. Millen, could you let Kevin speak, please?
Hey, Doug. Quick question. This one should be pretty simple. When figuring your measured moves, are you figuring from print to print, or are you figuring from the top and bottom of the move?
Top and bottom.
Top and bottom. Okay, and that's on the daily or on the
daily?
Gotcha.
So if you're doing the swing trading, you're going to be looking more on the daily. But when you're looking at the top and bottom, I want you guys to do 2 things, like I told you. Look at the volume pattern of the first area, and then when it goes to the second area of consolidation and build, look at the volume pattern. Because what's going to happen, as you saw in OKLO, less volume, it was only building between 8 and 10. More volume and time, it was building between 18 and 28. So that also increases the potential of the next calculated move. Make sense?
Yes, it does.
And it did. That's what OKLO did, right? Same thing.
Yes.
All right, next question. Oh, I've really done a great class if I've got no questions today. Well, if we have no more questions, I really hope you've all enjoyed the first 3 classes. We got 3 more to go. Still a lot, just to let you know how the next 3 go. Next Wednesday, we're going to be doing, and I'll give you a quick peek, a 7-point company analysis. I want you guys to read it. Have a quick read so you know what's coming on Wednesday. This is going to be the whole of class 4, how to break open a company. Class 5, I'm going to do quick trader psychology. We're going to have our psychologist come in and speak to you about psychology and about how our psyche is. She's going to be coming in on Wednesday for half an hour. So that will be Wednesday's class. We will be finishing this off, class number 6, next Thursday. And I'm going to be doing a complete case study of OKLO, showing the prints, showing the movements, a completed 7-point company analysis, their C-suite, which is their leadership, what products and services, the market share, a quick understanding of financials, and lastly, headwinds, tailwinds, and the red dress. So a lot to look forward to. Hope you guys have enjoyed this week's of classes and have a lot to apply, a lot to learn. And I look forward to next week. Hope you all have a wonderful rest of your day.